revaluing gold is hardly a cure-all. It's at best a sugar high. The real problems with our debt are so much bigger than that. And that, frankly, even if we did do that, again, be careful you ask for, because when we start showing our cards, other countries, in particular China, are gonna have a little bit more gold than we think. And if we revalue gold and they do the same, they're going to cut down their debt at a much faster level than the US. And so if we take that route, it's going to be a domino effect. And I think that's what Kissinger was very afraid of in the 70s. We should be just as much, if not more, afraid of it in 2025. My guess is we don't have nearly as much gold as we think. But again, we're all speculating on that right now. I'm certainly confident to say that China has significantly more gold than the World Gold Council reports.
In February, China's central bank proudly increased its gold reserves for the fourth month, showcasing its dedication to diversifying reserves as gold prices reached impressive new heights. This exciting trend mirrors a global movement of central banks embracing gold as a vital strategic asset. Additionally, growing speculation regarding a possible U.S. gold revaluation highlights the increasing importance of gold in our ever-changing financial landscape. It's an optimistic time for gold's future as a sound reserve choice. MatthewPiepenburg, a senior analyst, suggests that if the U.S. were to revalue its gold reserves, it could trigger significant global financial shifts, particularly benefiting countries like China, whose actual gold holdings may be far more important than officially reported. Marking U.S. gold reserves to market is an exciting opportunity to align our economic strategy with global currency and asset valuation trends. Gold has long been a reliable value store, helping shield economies from inflation and currency drops. The U.S. could tap into new liquidity by revaluing these reserves and creating an effective fiscal tool, especially with rising debt concerns. While this approach could provide a helpful short-term boost, it's essential to recognize that it's just one piece of the puzzle in addressing our country's broader economic challenges. Piepenburg notes that such a move could generate between $800 billion and $1 trillion, which remains minor compared to the vast U.S. debt burden. The approach, though strategic, would act as a short-term adjustment rather than a fundamental fix to deep-seated fiscal imbalances. As central banks accumulate gold, bullion's role as a hedge against economic instability gains prominence. While revaluation presents potential economic advantages, it also necessitates careful consideration of its long-term viability within an increasingly complex financial system. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
If we were to take that $42.22 certificate and market to gold market to market based on current gold pricing, you're looking at, assuming again that we have over 8,000 tons of gold in our banks and in Fort Knox, et cetera, you're looking at approximately 800 billion. And if we want to be generous, let's say $1 trillion that we could revalue and plug that, have the Fed plug that in the Treasury, and then we'd have $1 trillion extra money in liquidity. Basically, it's kind of QE with gold, and that's great. Let's say it's $1 trillion, but again, it's closer to 800 billion. But really, what's 800 billion? It's a guppy again against a whale. It's 1 year's military budget. It's 2 quarters of unlimited QE, which we've seen in the past. In other words, it's not, I mean, $1 trillion is a lot of money, but given the massive scale of debt in the US, whether it's public debt or whether it's combined corporate household and corporate debt, that $1 trillion is a dopamine rush, but it's hardly a cure. And what I was talking about in that article more particularly is something about Kissinger. Be careful what you ask for if you revalue gold. If the US were to do that market to market, other countries have. Kissinger saw this in the 70s. A lot of European countries, which at the time had more gold than the US, were thinking, look, we're in debt. We're staring down the barrel of a debt crisis. Why don't we revalue our gold? And why don't we get the US to do that too? And Kissinger was very, very afraid of that. And Kissinger's a very clever guy, whatever you think of him, because if you do that, then who has the most gold wins, and that, so to speak. It's a cliche. Like, it's not a gold bug conspiracy theory. We all of us in the industry know that the World Gold Council's view of China's gold holdings or Russia's gold holdings, for example, are woefully inadequate. I think they're off by 10x when it comes to China. So, China is the biggest importer and producer of gold. Russia produces 2x the amount of gold the US does. So if you actually were to revalue gold and other countries were to follow, we wouldn't be at the top of the World Gold Council's list as the most gold-rich country. And so there is that Kissinger fear. But as I said in the article, it won't stop us from doing it because we are desperate. But the U.S., which is the home of the world reserve currency, and the 10-year U.S. Treasury, which is a sacred bond instrument, It's desperate now, and that's what is really when we're talking about these type of measures, whether it's a strategic Bitcoin reserve to, or whether it's revaluing gold. I mean, we only have bad options really, and one option is kind of to play the Yellen card, which I said in the article. We could issue more IOUs from the short end of the yield curve. Uh, then we have to hope that there's somebody at our treasury auctions to buy them. But when you look at the fact that our interest expense on debt, our military costs, and our entitlement costs are over 140% of our tax receipts, even a Yellen playbook isn't really enough to solve a real debt crisis. We could create again a Bitcoin bubble like El Salvador did and hope for the best, pump up Bitcoin, take some of those winnings and use that to pay down some debt. To me, that's very desperate. We could revalue gold, as we just talked about, maybe get a trillion, 800 billion to a trillion. Again, not a big solution. Given the massive level of US debt and massive importance of the US as a global economic leader, I've always said, and I've said it for the last 10 years, I'll say it for the next. Our only real option is to inflate or die. In other words, to inflate away our debt, debase our currency, monetize our bond market with mouse click money by adding zeros at the Eccles building. That's been the playbook. That sadly is really our only real option going forward, and we're just waiting for a trigger event for that. Or we could have that in combination with some type of global reset that the IMF kind of telegraphed in 2020. Again, none of those things are pretty. None of those things are easy. But if we did revalue gold, to your question, that would be certainly a major tailwind for the gold price. It would be very poor for the U.S. dollar, but a weaker U.S. dollar might be good to help the U.S. reduce its debt to GDP. But ultimately, what I wanted to make very clear in that article is revaluing gold is hardly a cure-all. It's at best a sugar high. The real problems with our debt are so much bigger than that. And that frankly, even if we did do that, again, be careful you ask for, because when we start showing our cards, other countries, in particular China, are gonna have a little bit more gold than we think. And if we revalue gold and they do the same, they're gonna cut down their debt at a much faster level than the US. And so if we take that route, it's going to be a domino effect.
The silver market fluctuated early Monday, hovering just above the $32 level, maintaining its long-term uptrend despite short-term volatility. Traders continue to view silver as a precious and industrial metal, though its industrial demand remains uncertain amid recession concerns. As a result, silver may lag behind gold, but short-term pullbacks, particularly near the 50-day exponential moving average at $31.64, could present buying opportunities. Since the start of the year, silver prices have risen by 12.67%, reflecting growing investor interest. Meanwhile, the gold-silver ratio dropped slightly to 89.45 on Monday from 89.56 on Friday, indicating silver's relative strength against gold. According to analyst MatthewPiepenburg, silver's volatility makes it a high-risk but high-reward asset. Silver tends to surge explosively once momentum builds, unlike gold's steady climb. Let's get back to the interview.
And silver, I think, is fascinating. I mean, silver to me is biblical. It's literally mentioned. I mean, Jesus was betrayed for pieces of silver. Our Constitution mentions silver in its original form before we destroyed sound money in 1913 when the Fed was created. And silver, even as far back as 1935 in China, silver was part of their currency. That's not that long ago. Yet to me, silver is fascinating. I mean, really, we were talking about this in Cape Town just in February, year over year, silver's up 48% from year over year. And yet it's still probably one of the most undervalued assets in the world. And, it's kind of cascades the poor man's gold. I think that's an unfair. I think for the smart man, it's the smart man's investment, not the poor man's gold. Rick Rule famously said a couple of years ago, I quote him all the time, silver rewards infrequently but extravagantly. And I think that's something we need to talk about. I think that's something retail investors have to think about. The gold silver ratio is now around 90 or above 90. It's nowhere near 1980 or 2011. It was like 15 and 32 levels. It does have a lot of tailwind behind it. It's got 7-year supply deficits. I mean, you've got open pit restrictions in Mexico, so you can't even mine pure silver. We've had 12 to 14 coups in parts of Africa where most of silver is mined. So there is this massive supply mismatch, and I think that's going to help the price longer term. A lot of conversations have been had in the last few weeks or months about China and the People's Bank of China having really been suppressing gold since 1983. China's been buying gold kind of off the radar of the IMF or the World Bank. And, whenever a major mine operation, certainly Glencore, when they were mining silver and they needed to cash to pay operations, to pay management. They needed to get it to refineries. A lot of those refineries, a lot of those buyers were in China. So they've been doing very quietly what the Chinese, whatever you think of them, do best. I always say they're playing chess while the rest of us are playing checkers. They've seen the writing on the debt wall in the West in general, in the US in particular, for decades. And as we've been going further and further into debt, issuing more and more IOUs and debasing our currencies and printing more of them, they've been stacking silver and gold very carefully, very deliberately, and very quietly. And that includes silver. So there's a number of forces at play, whether it's supply and demand mismatches, whether it's suppression out of China, and whether it's just the gold silver ratio coming back to equilibrium into even in the 30s or 40s or 50s. That gold could really, I mean, excuse me, silver could really skyrocket. We always say that silver is, not for widows and orphans, Egon's famous phrase, it is the little jet speedboat next to the big gold juggernaut. When silver moves in any direction, it's fast and furious. Gold kind of moves along at a steady kind of secular pace. When gold really catches more and more momentum, silver will follow. And so for those who have been buying silver at 10, 15, 20 and hoping for 50, 100, 150, again, as Rick says, you got to be very patient, but the rewards will be extravagant. I don't think you have to wait for 20 more years to see silver really rip. And for those who can't or don't want to buy large amounts of gold and can get more silver right now, whether it's at a retail shop down the street or at a private vault somewhere outside of that, I think it's a long-term play, and I think it'll be a very generous play. But I know they've heard that for years, but silver has rewarded in the last year, certainly. And, as I said often from the Gladiator, are you not entertained? But until silver is at 100, 150, 200 or higher, they think it's not doing what it's supposed to do. I think it's a very smart play for retail investors. And again, I instruct them all to just stay informed on that, follow the silver markets, even what's happening in the COMEX, because COMEX didn't just manipulate the gold price. When you see gold leaving the COMEX, that means there's less gold available for the COMEX to lever at 96% paper and 4% gold. It's the same with silver. Silver's been leaving the COMEX at record levels as well. So the ability to price fix legally on the COMEX is getting weaker. I've warned that was going to come for the last 4 years. It's happening as we speak. And it also, again, these supply deficits and this suppression out of China, all these forces are coming to play, I think, is a real tailwind for silver. And I think it's a fantastic investment for retail investors.
As central banks ramp up their gold purchases and conversations around U.S. gold revaluation gain traction, the significance of precious metals in global finance is truly growing. Gold remains a key player in ensuring monetary stability, while silver offers unique market dynamics that can present both exciting risks and opportunities for investors. With the financial landscape shifting rapidly amid economic policy uncertainties, one must wonder, could a revaluation of U.S. gold reserves transform the global financial system? Or is it just a temporary remedy for underlying economic challenges? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.